All right, guys, this is Mr. Abraham, the trader of Gova Trading Academy. All right, so yesterday we were analyzing gold yesterday, which I told you guys that the first thing we usually do in the professional course is to mark out the monthly equilibrium line, which is here, as you can see, right? Prosper. So then the next thing you need to do, the next step you need to take, you can see the first step is to mark out the monthly equilibrium line. The second step, that is if you want to take the weekly trade, the work trade, okay, the work trade. Then the second step is to mark out the weekly equilibrium line, which is on the H3. But remember, you are not going to mark it out physically the way we mark it out physically, the way we mark the monthly equilibrium line physically. The weekly equilibrium line, we won't be marking it physically, you understand? We are only going to be marking it in our mind. You understand? We are going to be marking it in our mind. Marking it in our mind, this is what I mean by marking it in our mind. I can see that the monthly equilibrium line is currently here, right? So roughly, I can see that the weekly equilibrium line is going to be, remember, so at the time of the analysis, this area was not there yet. This area was not there yet as at the time of the analysis, right? Which is last week. Last week, this area, nothing is here around here last week. The area is empty. So what we have last week is that we have current market price around here last week. You understand? So which means that towards the ending of last week trading session on Friday, we can see that current price is currently around here towards the ending of the session on Friday, before market close on Friday. So what is that telling us? That is telling us that roughly we have our monthly equilibrium line far above, and then we have our weekly equilibrium line, which is roughly in our mind. We know that market price is going to open on Monday roughly anywhere around here, isn't it? Monday market is going to open around here roughly. We don't know exactly where Monday market is going to open, but what we know is that it is going to open anywhere around this area roughly. You understand? So it means that in our mind, we are able to tell that this is going to be a sell trade alignment. Anywhere the market open on Monday, it is going to automatically be a sell trade alignment. So right now, we didn't mark the equilibrium line yet. What we did was we marked the weekly equilibrium line at the back of our mind. You understand? So the only time we mark the equilibrium line for weekly is when Monday market open, or when the market open on Sunday. You understand? That is when we mark the equilibrium line for the week. Madam Ozioma, are you following?
Yeah.
I think that question is one of the. All right. So we didn't mark it as at the time we were doing the analysis, but when market open on Monday, then we were able to see exactly where the candle is. Then we mark it at the proper area where it's supposed to be. You understand? However, we've already done the analysis that roughly that area is going to be a sell alignment, because my Monday market is going to open anywhere around the area. Okay.
Do we mark it every day?
No, we mark it every single week. We don't mark the weekly equilibrium line every day. We mark it every single week. Okay. Right now, hold on, please. Like right now, last week equilibrium line. This is where last week equilibrium line is. The weekly equilibrium line for last week trade is here, isn't it?
Yeah.
And it has already worked out. This trade has already played out already. Because remember, this is the zone. We also have a zone on a lower time frame, isn't it?
Yeah.
We also had a hidden zone on a lower time frame, which is this one. Can you see that?
Yeah.
Prosper, do you understand what I'm doing here?
Yeah, yeah. But then how did you find the hidden zone? The daily EQ?
By switching lower. First of all, the zone, first of all, look at it. First of all, we were able to determine last week that this area on the DEQ. Okay, let's look at the calendar, because it is important for me to show you guys the calendar so that we follow along what is happening in the calendar. Now you can see last week is what? We have Wednesday. Wednesday is 0, 2. Thursday is what?
3.
Friday is 4, isn't it?
Yeah.
So let us check. Let's check. Going back to the chart again. Going back to the chart. Now, going back to the chart, let me remove this green line now. Going back to the chart, remember, as at the time of the analysis, this area has not happened yet. So, but let me just look for Friday candle. So 0, 4 is Friday candle, which is this bullish candle, right? If Friday candle is this bullish candle, it means that this bearish candlestick we are having here is Monday candle. And it means that we don't have the candlestick yet, as at the time I was doing the analysis last week. So let me erase it out, isn't it? As at the time of the analysis, it was clean. That area is nothing is there in that area. What we only have is the bullish candle around that area. Do you understand what I'm trying to do here?
Yeah.
So now it means that the Friday candle is bullish. Now we are going to be ignoring this bullish candle. Prosper,
Yes.
you know why we are going to be ignoring the candle? We are going to be ignoring the candle because, hold on, guys.
Okay.
All right. We are going to be ignoring the bullish candle because the alignment we are looking at is a what? Sell alignment. And in a sell alignment, we won't be looking for a bullish candle. So in a sell alignment, we are seeing a bullish candlestick on Friday. So it means that Friday candlestick is canceled out, right? Canceled. Now, what about Thursday? You know, Thursday, this is the candlestick on Thursday, this small candle, this small bearish candle here, isn't it?
Yeah.
Now, on this small bearish candle, what can you guys see? Can you guys see that the candlestick is looking like a square in shape, isn't it? It's looking like a square. It is not looking like a rectangle at all. So if the candlestick is looking like square, it is also what? Cancelled. Okay, you need to cancel it out. Then what do you need to do? You need to look out. You need to look at the candlestick that is on the previous area also here, which is the next one. You understand? After looking at that candle, you can see that the next candlestick is a good candle, right or wrong?
Right.
Prosper, right or wrong?
Yeah, it's correct.
Then on this candle, what is the supply of the candle? The supply of the candle, remember, it is from the opening anywhere around this area is the supply, right, of the bearish candle, isn't it?
It is.
Now it means that we are going to highlight our proximal line, distal line roughly around the candle like this. And also, guys, remember I told you guys that your 3 dots, your 3 dots should be sitting in a straight way on the wicks. Do you understand? On the wicks. Some of you asked me this question, that what if the candlestick does not have wicks? Well, if the candlestick does not have wicks and this is the bearish candle, then you should be able to mark out your zone like this. Hold on. Then you should be able to mark it like this. You understand? I'm getting, guys. So you can see it is still our proximal line is still at the what? It is still at the opening of the candle. Yes or no?
Yeah.
It is still at the open. It is still at the open. So that is how to do it. So sometimes if your candlestick is not having wicks, then you mark it at the opening of the candle. That is still a supply. That is still a supply, depending on whether it's a bullish candle or whether it's a bearish candle. You understand? Vice versa. If it is a bullish candle, you know what to do. You know the demand of a bullish candle. If it's a bearish candle, you know the supply of a bearish candle, right? Yes, guys.
Yes.
All right, let's move on. Let's move on. Now, the reason why we canceled Friday candle, you guys know the reason why, because we are in a sell alignment and we are not going to be looking for a bullish candle in a sell alignment, isn't it?
It is.
Now, the reason why we canceled out Thursday's candle is because the candlestick is not looking good. It's not looking good. Now, the reason why we are looking at this candle here is because the candlestick here is looking good, and it is also a bearish candle. Prosper, are you following? Does that make sense to you?
Yes, I'm following. Yes.
All right. Now, the next thing to do, after you've already highlighted your candle, which is on the D1, the next thing you need to do is to switch back to a lower time frame. you can switch back to H2 or H3, anyone you like to choose. Just switch back to a lower time frame. And then when you switch back to a lower time frame, the candlestick, the formation you can see on the candle on your proximal line, distal line, you can see the formation we saw when I switched to a lower time frame, right? The formation on the area is what? A rally-based drop, isn't it? That's the formation there, right?
Yes.
Now I'm trying to answer your question on how did I find the zone, Prosper. Okay, this is how I find
Yes.
I found the zone
Yeah.
this way. So now, after switching to a lower time frame, what we only need to do is by marking the zone, proximal line, distal line properly, because on a higher time frame, we just highlighted it roughly, isn't it? We only highlighted the rough way. So when we switch to a lower time frame, you need to calm down and mark out your proximal line, distal line in a more proper manner. You understand? When you switch to a lower time frame. So now this is the first zone here. But remember, look at it first. This formation now is a formation that looks like this, isn't it?
Yes.
And in a formation that looks like this, remember I told you guys that you need to mark out your distal line here and your proximal line exactly here, isn't it?
That's correct.
But remember, I also advise you guys that if the zone, what about the zone? If the zone is looking too high, because okay, let me just mark the zone like this now. This is the right area to mark the zone, isn't it? If this zone is having 20 pips, 30 pips, it is a good zone. You can see the trade triggered, right? If it is having 20 pips, 30 pips, 40 pips, 45 pips, 18 pips, 10 pips, it is a good zone. You don't have to reduce it. But look at it. Right now, the zone right now is looking too big in pips. The pips on the zone is, look at it, from proximal line to distal line. That's about 85 pips, 84 pips. That's too much. That's too much. You understand, isn't it? That's too much. So if the zone is too much, you can manually reduce the size of the zone on your own. You understand? You can manually reduce the size of the zone by yourself. So manually reducing it, I'm going to reduce it to this area like this. So the first zone is going to be here. My second zone, I'm going to look for a lower time frame. I'm going to switch to a lower time frame to see if there's something happening in this area on the lower time frame. Okay. Let me see if something is happening there. So M30 to M20. So you can see on M20, something is happening below, right?
Okay.
Do you understand? So you can see, and remember what I usually tell you guys. I usually tell you guys that if two zones are close to each other, you guys can mark it, right or wrong?
Yes.
I usually tell you guys that if you have two zones that are close to each other, so far as the two zones are close to each other, you can mark out the two zones. Out of those two zones, one zone is going to work, one zone might not work. You understand? Banks might decide to come into the market and go up into the upper zone here. It means this first zone here is going to hit stop loss. Market is going to come down. When market is coming down, the loss you made on the first zone has been recovered when market is coming down. Yes or no?
Yes.
When market was going up, you made a loss when market was going up. But when market was coming back down, you made back your loss. Your loss has been recovered. So that is it. So sometimes the market is not going to go to the upper zone. Market is going to stay within the lower zone. And you can see that is exactly what happened on this gold trade. Market decided to stay within the what? Within the lower zone. And within that lower zone, the risk on this zone, look at it, this is about how many pips, guys? Madam Ozioma, how many pips?
23 pips.
No, this is not 23 pips. Prosper, how many pips is this?
23.6.
No, this is not 23 pips. This is not 23 pips. Kester, how many pips is this? Hello, Kester.
2.36.
Is Kester there? Okay, Abdulaziz. Abdulaziz, how many pips is this? Hold on.
It's 23 pips.
Yeah, it is 23 pips. Okay, it is 23. I'm just trying to confuse you guys. All right, it is 23 pips. So 23 pips is on the zone. What about the reward? What about the reward? From the proximal line all the way down to where market price drop down to, you can see market price drop down all the way here, isn't it?
Mm-hmm.
We are going to be calculating from here down to this area. How many pips reward do we get from that area? Let's see. Let me calculate it. Madam Oziom, I hope you know what we are doing, right?
Yeah, yes, I do.
So from here to here, you can see that's about 329 pips. 330 pips. Can you see that? 330 pips. 330 pips. So 330 pips divided by 23 pips is going to give us what? What is the answer?
14.
That's one
That's
risk what?
182.
What's the meaning of RRR, Madam Ozioma? What's the meaning of RRR?
Risk to reward ratio.
Yeah,
Risk
risk
ratio. Yeah.
reward ratio.
Yeah.
Risk, reward, and ratio
Ratio.
equals to 1 ratio
14.
1 ratio. Let me divide it. 330 divided by 23. Let me see my calculator. I like using calculator. I don't like using my head. 330 divided by 23. That's 14.34, right?
Yeah.
And Prosper, remember I told you guys to always throw out this area out, isn't it, Prosper?
Yeah.
What we have is just 14. So it means that on this trade, on this gold trade, we have a massive 1:14 as a reward. 1:14. Imagine risking $10 on this zone. Okay, this is the question, Madam Ozioma. You need to answer. If you are risking $10 on this zone, if you are risking $10 on this zone, $10. How much profit did you make using 1:14?
3,300.
No. If you are risking $10, and you got a reward of 1:14, how much profit did you make in dollar?
Okay, is 140.
Correct.
$140.
Correct. It is 140. It is very simple. You just need to multiply the risk you took and the reward you got. You understand? To get the amount you made. You understand, isn't it?
Yes, it is.
The profit made on this trade, if you are risking $10, is $140. Imagine which business is going to give you a risking of $10 and then making $140. This $140 now in Nigeria is 140 times 945, because
Are you serious?
Naira is now 945, almost 1,000.
Wow.
So that is 132,000. You understand? Because this Tinubu's regime, within just how many months he entered, and Naira has rise up massively within how many days? I don't know how he's managing the economy. He's just doing bad, very bad. All right, guys. So that is it on this trade on gold. All right, on gold. So I believe you understand the example I just made here on gold, right?
Yes.
Now, what about next week trade? What about the trade that is going to happen next week? You see, this is the trade that happened last week, right? The analysis we did it last week. Market came back. Let me even see when markets came back. Let me see the dates when markets came back to the zone. Okay, markets came back to the zone on Friday. You can see we saw the zone on what? Wednesday. You see, Wednesday. This is Wednesday. The zone was on Wednesday. Remember, this is Thursday here, right? This is Friday. This is Friday here. So we did analysis on Wednesday. Markets came back on Friday and then trigger Friday and then went down on the next new week, which is this week. So now this week trade is already gone. Do you know why I said it is gone? It is over because the profit on this week trade has already been given. Yes or no?
Yes.
So it is gone. We need to start afresh again. We need to start the analysis afresh because we are approaching another new week, right? We are approaching another new week. So again, let's go back to the D1 time frame. Even without going back to the D1 time frame, on the H3 time frame, we can still see that we are still in a what? We are still in sell alignment, isn't it?
Yeah.
we are still in a seller line because the blue line is far above and the green line is going to open anywhere around here on Monday, isn't it? Anywhere around that area. So now it means that we should look at the D1 time frame candle. On the D1 time frame candle, the candle, yesterday's candle, yes, this is yesterday's candle because this candle did not open yet as at the time of the analysis. We didn't have any candle here as at the time of the analysis yesterday. Okay, so the only candle we have is what? Is this bearish candle here. And this bearish candle is a good candlestick because you can see the body is looking like a what? Like a rectangle, isn't it, Prosper?
Yes.
So what I have to do is just to mark out the what? The supply area of the candle is to highlight the supply area of the candle. After I highlight the supply area of the candle, what I need to do, sorry guys, what I need to do is just to switch lower, right? What I need to do is to switch lower, isn't it, guys?
Yes.
What I need to do is to switch lower so that I can see where the zone on that candle I highlighted is. So you can see this is where it is. This is the formation when I switch lower. Can you see that? Prosper, can you see how easy it is to analyze using this method now?
Yeah.
Because right now you can see it has not, the trade has not happened yet, even though it has already happened, but let us assume it has not happened yet, yesterday, right? Yesterday, this is the only thing we are seeing yesterday. Just like Madam Ozioma analyzed it. This was what we saw yesterday, isn't it, Madam Ozioma?
Yes.
Yeah, you did a very good analysis. Keep it up, okay?
Thank you, sir.
So now, after you highlight the zone, when you come back to a smaller time frame, remember you need to come and mark it properly because you cannot just leave it like this, isn't it? You need to come in and then highlight it more properly in a more proper manner to mark your proximal line and distal line in a more what? In a more proper manner, isn't it? So you can see marking it in a more proper manner, we can clearly see the basing candlesticks. Look at it. Remember the small basing candlesticks here? You can see them, right? So remember, in such situation, we usually mark out the distal line above the proximal line like that, isn't it, guys?
Yes.
Yeah, so let me mark it again. So you see how market came back today and the market trigger it. So that is going to be the supply zone of next week. You understand? Market is going to continue going down till next week. The only thing that is going to hold the markets down around this area is if the area is in a major demand level. You understand? So right now, if I'm the one taking this trade, I'm going to be taking my profits right now. Do you know why I'm going to be taking my profits right now?
Yes, because there's an opposing zone just to your left.
Yeah. I'm going to be taking my profits, Madam Ozioma. Listen, okay? I'm going to be taking profits right now because this trade right now has already given us the profit we are looking for, right or wrong?
Yeah, it's true.
It has given the profits we are looking for. The only time we can hold the trade, the only time we can hold down the trade till next week is if the trade has not moved down yet. If the trade has not yet moved down, maybe market price is still around here. Maybe market price is still around this area. It has not moved down yet. Then we can still hold the trade all the way to next week. You understand? But right now, we can clearly see that market has already moved down. Already, it has given us a risk-reward ratio of, let's calculate the risk and reward. From proximal line up to the distal line, you can see this is 27 pips, right? Now the reward, you can see the reward here is 174 pips. Can you see? So 174 divided by 27. Hello guys, are you following? 127 divided by 174 divided by 27. That is going to give us what? 174 pips reward divided by 27 risk, 27 pips risk is going to give us what? Let me use
6.4444444.
174 divided by 27. 174 divided by 27 is going to give us 6.444, right? 6.44444. So we know that we don't need this. What we need is just the 6, isn't it? So it means that this trade is giving us 1:6 already. Are you telling me that 1:6 is not enough for you? Are you looking for 1:1 million?
More than enough.
So you should be satisfied. You should be a satisfied trader, because a greedy trader is not good. You understand? You should be a person that is satisfied with whatever profit you made. Remember, the minimum reward we are looking for in the first place is 1:3. And you saw something that gave you 1:6, and you are still waiting for next week. Come on, you need to close that trade, isn't it?
Yes.
So that is it. So this week trade on gold has already given us the profit. So we are no longer going to be looking at it next week anymore. Profit has already been given. Now, but one thing about it also is market right now on this gold is approaching a major demand level. Now, what is a major demand level, Madam Ozioma? This is what I mean by a major demand level. A major demand level means that you see what market structure is. Look at this is what market structure is. If market is doing something like this, you see this is a structure, isn't it?
Yes, it is.
Market behavior. Now, what do you notice around these levels? Whenever market price come into this level, do you notice that market usually rejects around here?
Yeah.
Market came here and rejected and sold down. Market came here, rejected and sold. Market came here and rejected and sold off. Right?
Yes.
Market, whenever markets come into this area, what's usually happen? Market usually rejects and rally up and go up, isn't it?
Yes.
That's behavior. So is it good to be taking a sell trade around this level, around this area, a sell trade around here?
No.
It is not good. What about this area? Is it good to be taking a buy trade around this level?
No.
It is not good. But what about this level too? It is not good to be taking a trade around that area, because we can see what the structure is. Remember, we have what we call internal structure and external structure. We have internal market